Total costs are the complete cost of producing output. We use three measures. First, the green curve on the graph is showing the total fixed cost of production. Total fixed cost is the total cost of the fixed asset that the firm uses in a given time period. Since the number of the fixed asset is, by definition, fixed, total fixed cost is a constant amount. It is the same whether the firm produces 1 unit or 100 units. We could see that the curve for the total fixed cost is constant throughout in the graph. The y-axis is the price in dollar, while the x-axis is the output in units. A horizontal curve means that the total fixed cost is constant no matter how many units we produce. For example, total fixed costs could include costs such as rent for the factory. And this horizontal total fixed cost curve means that the rent will stay the same no matter how many units we produce. Second, the black curve is the total variable cost curve. Total variable cost is the total cost of the variable assets that the firm uses in a given time period. Total variable cost increases as the firm uses more of the variable factors. We could see that the curve has a y-intercept at the origin. It is because if you choose to produce nothing at all, there's no variable cost needed. Variable cost increases as the output per unit increases, meaning if you produce more, the variable cost would go up as well. For example, if you're operating in a hot dog company, more staff are needed to produce more hot dog, and more staff means higher variable costs because variable costs include costs such as wages and salary. The total cost curve is in red. The total cost curve is parallel to the total variable cost, simply because of the following equation. Total cost equals to total fixed cost plus total variable cost. As we've said, total fixed cost is the same no matter what the output is. And when we add the total variable cost on the total fixed cost, it would be parallel because we're adding a constant amount into. The following diagram is on the average total cost. Average total cost is the total cost per unit of output. Mathematically, average total cost equals to total cost divided by the unit of output. Average total cost tends to fall as output increases, then to start to rise again as the output continues to increase. At the point where average total cost is the lowest, we call it the optimal productivity point. It is because it has the best combination of production causing the average total cost to be the lowest. Anywhere before this optimal point is benefiting from increasing economies of scale, while every point behind this optimal point is suffering from increasing diseconomies of scale. Economies of scale is the benefit for a firm for operating in a larger scale, while diseconomy of scale is the opposite, having a negative impact while operating larger. An example for both could be a hot dog store as well. As more workers are added into the hot dog store, it would be economies of scale because some of them are specialized in a specific area, hence making the process faster and more efficient. However, it could be this economy of scale because, say, the capacity of the store could only hold 10 staff, and the next staff you hire after 10 would make it tight and hard to move around within the store. To simply decrease the productivity because there isn't enough space to move around.
This Venn diagram shows the relationships between different kinds of costs. There are 5 different costs in total, which include fixed costs, variable costs, semi-variable costs, direct costs, and indirect costs. Fixed costs are output independent because businesses have to pay regardless how much it produces or sells. This also means that this cost has to be paid even if there is no output. An example would be rent, because no matter how good or how poor the business performs, they still need to pay the rent. And in most cases, there should be a contract that they have signed before renting a place. Hence, they could not run away and hide from this rent payment. Variable costs are output dependent because they change proportionally to the level of output or sales business makes. Raw material is an example of variable cost. When a business wants to increase their sales, it needs to increase their production cost too. Semi-variable cost, according to the Venn diagram, clearly shows that it contains elements of both fixed and variable cost. This cost would become variable only when products or sales reaches a certain level of output. For example, a mobile phone user only has to pay a fixed cost for 500 minutes of phone calls per month. However, if the person exceeds this limit, the phone bill would become variable. The fixed cost and variable cost can be either direct or indirect. Direct cost means that the cost is directly related to the output or the product of a business. Both fixed and variable costs can be direct. An example could be when you purchase a brand new vehicle. The fixed cost is the cost of the car, while the variable cost could vary depending on the upgrade and parts. Both of the costs could be clearly seen and relate to the output. Indirect cost means that the cost is indirectly related to the output or the product of a business. An example of indirect fixed cost is electricity cost in order for business to keep operating. An example of indirect variable cost is postage cost because this cost depends on the location of the customers.